Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest on the show, just head on over to missionmatters.com and click on Be Our Guest to Apply. All right, so today I have a very special episode. This is part of the Venture Debt Conference series that we've been putting together for the guys over at Deal Flow Events and all the great work Phil and his team have been doing over there. And my guest is Benjamin Wu. He is the head of East Coast and managing director over at ORIX Growth Capital. Benjamin, welcome to the show.
Thank you for having me, Adam. Good to see you.
All right, so we got a lot to cover today. I, of course, want to get into the work being done at ORIX Growth Capital. We're going to talk a little bit more about the Venture Debt Conference coming up, where I understand you're going to be one of the panelists and on a panel and doing some other things. We're going to get into the state of the growth debt market overall. What does that look like, especially after the emergence from the 2022 downturn? So that much more. But to get us started, we're going to start this episode the way that we start them all, with what we like to call our Mission Matters Minute. So Benjamin, at Mission Matters, our aim and our goal is to amplify stories for entrepreneurs, executives, and experts. That's what we do. Benjamin, what mission matters to you?
My mission in doing what I do really is to, I would say, change the world, one growth capital investment at a time.
Yeah.
What I mean by that, thank you. What I mean by that is I've been fascinated with technology since I was a kid. I was coding, I think, at 11 or 12. And I helped pay my way through college by working at IBM, coding on the Olympics web server, and have loved tech since then. And so what I've done is, in those 20 years since college, I've been investing in both tech and non-tech businesses across private credit and private equity. But what really interests me is finding interesting technology companies that I think improve efficiency and resiliency in the world, and being just a part of their journey and touching those companies. And the way I do it is by giving them money, and hopefully that is a good thing over time.
Yeah. That's great. Love bringing mission-based individuals on here to share what they do and why they do it, and really how they're doing it. So we all learn as well from that. I want to stick in and go back to those early days a bit longer here. So you're into tech. You obviously, as you said, paid your way through college by working, for a firm, for IBM. Like, when did that love for tech, I don't know if it morphed or changed, or like how did that transition into finance work? Like, when did that take place and how?
Yeah, I mean, I would say the school I went to. So I did my undergraduate at Penn. I did this dual degree between Wharton and engineering. And I came in thinking that I was going to do all tech and really kind of build a software company one day. And I think what happens at the school I went to is everyone kind of stampedes towards finance. And so, I think as a mix, I ended up being much more very early in the private credit world, which is now a huge booming sector within managed capital. So I started, my first investment job was at Goldman, and then I was at Fortress, where I was the first associate in the direct investing side. And I kind of launched into a career over time where I was both in tech growth equity. I was one of the early folks doing growth equity at General Catalyst, which is now a 35 billion plus AUM company. So I've had a good track record of joining companies that eventually become much larger over time.
Dang, man, you trying to join Mission Matters? I'm just no.
I am actually, and I'm hoping that after this you'll offer me a role, but I need to do a good job first on this. So I'll try to be as charismatic as possible to the extent I can. But private credit, huge. Technology, growth equity has been, massive sectors that have been very high growth, and I think that over time I've kind of combined those two to be looking at a variety, which I'm sure we'll talk about, the growth debt sector as it pertains to investing in technology companies in the form of growth capital to help them drive their growth.
Yeah. Let's take a quick step back here. I don't want to assume that everybody understands maybe what the venture debt market even is. So maybe give us some definitions in there. Let's start with the basics as we build this conversation out.
Sure. That sounds good. I would say growth debt is incredibly intertwined with the equity market. So everyone's heard of venture capital. It's so well known, and even folks who don't know what VC is, are interested in hearing about it because it's well known. And so, VC as an industry has grown tremendously and has invested in very early stage companies, helping them launch their businesses, whether it be for R&D, sales and marketing, but a variety of different areas that help these companies launch. Over time, as these companies get larger and larger, they still need to consume capital. Much of the market is still in equity, where these companies, as they get larger and larger, and even up through pre-IPO, and sometimes after IPO, they're still raising equity capital to drive growth. And these investments can start from anywhere from, 100, 250K pre-seed to hundreds of millions of dollars and up, as they get towards pre-IPO zone. And that equity market is large, healthy, and is driven by a variety of factors, particularly around equity valuations and exits. The growth debt market has risen in parallel with the equity market, but in some ways much slower. A lot of the growth of tech has been on the back of strong equity investing, but the growth debt market basically provides capital to these companies in a way where these companies are not giving as much of their equity away as part of raising that capital. And so one day when they exit, they sell the company or IPO, they will own more of the companies than they would otherwise had they financed all of their growth with equity. And so I would say in the last 6-7 years, that market has continued to burgeon. It's quite a sizable market now. I think it's roughly a fifth of the equity market. And that market itself has burgeoned in terms of number of players, as well as between the bank and non-bank side of it. So it's a very robust market now, where companies are efficiently raising capital, or they're looking to raise capital, not only via equity, but via debt as well, via growth debt and venture debt.
And I understand, and getting back to the conference for a moment or two, I understand you're going to be participating in the venture debt conference. You're going to be talking about this and more. Maybe talk a little bit about the panel that you're going to be on for the venture debt conference. And I know it hasn't happened yet, so we're going to talk high level. No spoilers there. Obviously, the people there that are attending, they'll see it, and I'm sure maybe it's going to be recorded and distributed later. But give us a little bit of a flavor of what's going to take place.
Sure. Well, hopefully there will be some discussion on topics that's not all about tariffs and how it impacts the venture.
It's going to come up, though. Come on.
It's 100% going to come up, and it will probably be 99% of the conversation, and how it impacts the economy, and particularly this type of investing in this asset class. But the reality is that, as I mentioned, this area is growing. It's growing rapidly. It's been impacted in various ways through technology cycles. 2022, where we are today. Tariffs, it's intertwined with what happens with the overall macroeconomic environment, as well as with what's happening with the equity environment. But this panel specifically is talking about considerations in raising venture and growth debt, timing considerations, other considerations around how to raise it and what to think about when raising it next to equity. And excited to have that conversation. And I do think macroeconomic factors for any technology investor is a huge part of how one approaches a company, both in terms of, or the investment, both in terms of how well that company is going to perform, but also how, what are the investment cycles, and how does that impact one thinks about the investment? They're all very germane to the investment, I'd say, viewpoint.
What kind of trends are you following right now? Like you've been in this game for quite some time now. You see a lot of big companies you've worked for and with. What kind of trends? Like what excites you right now? What are you following?
Yes. So I'd say there's a number of different trends. I'll just start with the IPO market, which is basically just the almost the bellwether in terms of these companies that are being invested in by these VCs early on. These companies are looking to grow and grow rapidly by consuming capital, investing in their technology, engaging with customers, and eventually, if they're successful, they can IPO and therefore bring liquidity to investors and also to founders. The IPO market has been quiet the last couple of years, and as you've probably been following, they're a little bit more quiet now. 2025 was supposed to be the year where things opened up. It was going to be a great year. A lot of companies last year were thinking about post-election, there was going to be a raft of different IPOs this year. A lot of those in more recent, and by the way, like last week, a lot of these companies thinking, maybe we wait a little bit as we look for stability. That IPO market and the health of that IPO market really kind of trickles down to the entire ecosystem. So growth equity, these larger checks, they invest in these companies because they think they'll be able to get an IPO and get liquidity. If there isn't IPOs happening, growth equity often is a little bit slower as well, because that's how they they get exits in their investments and therefore raise new funds. And so the whole system is a little bit slower. Venture capital, which starts very early and of which sometimes returns are high single digits to 10 years plus, they have a very long timeline. So that has remained more active. So the earlier the stage, the more active it has remained. The later, in some ways, has been a little bit less active because those near-term exits are not there. It's tied very much to M&A as well. If there's an active and healthy M&A market, that also can kind of unstuck the system, but there has to be healthy exits. That has been sort of a real interesting, I would say, evolution the last couple of years where it's slowed down some. And how do these companies survive and raise capital in that environment? And I'd say two things. One, without a doubt, companies have gotten more efficient. They've looked at their entire cost base. And are they, number one, generating revenue that actually will make them money? Number two, do they have profitable operations that can help them become profitable or reduce the burn so they don't have to go out and raise so much capital? That's a huge part of it. And I would say number two, companies that are raising capital, equity capital, are very high growth. So they're really the companies that the equity investors want to invest in because they're growing very rapidly. There's a whole class of companies that are very high quality companies. They may not be growing quite as rapidly, such that they're raising equity capital. And we really, as growth debt investors, we're looking for companies that are really high quality companies, but still are not just raising equity capital. They want to raise debt capital. And that's very much a relevant type of company for us, where they're not thinking, okay, we are growing very rapidly. We're going to raise capital at very high equity valuations, but we also want to raise growth debt capital. And that has, I'd say, created customer demand, for lenders and investors to be able to invest in those companies. I'd also say one other trend is that the banks have gotten very involved in this market. There's a lot of banks now, especially post SVB, where a lot of professionals have gone to great banks. And so there's now a lot of players on the bank side. They are focused on bringing over deposits. They'll provide debt facilities that are efficient, as in the costs are less, because they can also bring over deposits. They're really looking to provide a full set of services to these companies. But there are also more the investor fund type investors like ourselves, non-bank growth lenders that are looking to provide capital purely without bringing over deposits. So it's two different types of providers of debt capital in this market that have evolved over time. And I would say they're both fairly robust right now as where we are in the market.
I want to spend some of the time that we have here, and I want to get into a little bit further into what you're doing at ORIX Growth Capital. And I understand that a big part of what you're doing is on the growth capital side of it, but maybe just give us an overview overall of the company and what you do.
Sure. So ORIX itself is a very large Japanese global investment firm, over 30,000 employees, over 20 billion market cap. There's a lot of different operations at ORIX. ORIX USA is a subsidiary of Overall ORIX. Overall ORIX in Japan is a large private equity investor, a lessor, financier of companies globally. ORIX USA itself has a number of different business lines, private credit, private equity, and also commercial real estate. The growth capital group sits within private credit, within the ORIX USA sub. And our group has been providing growth capital to the tech industry now for over 20 years. We've invested in over 200 companies. So it's been a stable long-term provider of capital to this segment well before I joined, since I basically entered this entire industry. And I would say the focus is finding recurring revenue, stable provider of mission critical products to customers, very much in the software, tech-enabled services, digital infrastructure sectors. And our core focus is growth debt and also structured equity, as we're looking to support these companies in their growth. And we'll sometimes invest in the growth equity rounds of the companies too. And typically we're investing $10 to $50 million end up per investment.
How does ORIX leverage its long-term presence in the market to approach, I don't know, maybe the current market or just market risk in general? Like how does that work?
I think that's a very important question as to how people approach this, because technology and tech growth and the entire industry is not without its ups and downs. Entrepreneurship itself is not easy, and any path has its ups and downs in the market. And as a result, it's really important to find capital partners that are going to stick with you. And some are some approaches are a little bit less, hey, listen, if you're not succeeding every single quarter, oh my gosh, it's not, we're not going to be supportive in the short term. It's really important to find partners that are going to be supportive over the long term, because it's a long journey. Sometimes it could be 10 plus years for an early stage company. And when the IPO market is slower, it could be a long time even for mature companies. And so I would say that it's really important to find partners that are long-term in nature. And I think that's something that's important here. It's when we're speaking with companies and they want to know, like, who are you and where's your capital coming from? And then how have you behaved in situations where, there's been macroeconomic cycles or we hit a speed bump? There's been a lot of examples over those 200 companies where ORIX in particular has been supportive of these companies through growth, expanding and giving more money if they're doing well, or if they're not doing well, supporting those companies through those road bumps. And I think that's really important. I think this market over time has been one where the participants that have been supportive to the ecosystem are ones that have continued to grow and thrive in order to be successful in this market. And I think that's an important part of how this group here operates.
Amazing. Well, Benjamin, this has been, I've learned a lot today about current market trends. I know I'm excited about the upcoming Venture Debt Conference. I have to ask, what's next? What's next for you? What's next for ORIX and the company? What's next?
Yes. So I think for ORIX and company, this group is growing. It remains very committed to this market. We've got a sizable balance sheet. ORIX overall has $100 billion plus balance sheet. And so there's balance sheet capital, third-party capital that is dedicated towards supporting this effort and this market. For me personally, I'm kind of a creature of habit. I'm not going to mention my age, but X number of years ago, some may say decades ago, I was like loving tech, and I just don't think I will ever leave it. And so my goal is to either be investing in building and supporting interesting technology businesses for my career. And I think this new AI revolution is incredibly fascinating. We've already made an AI investment earlier this year, and I'm just super excited to be part of what I think will be quite transformative for U.S. and also global society and humanity, frankly. And I, if we go on that tangent, I could talk your ear off probably too long. But I think that's partially why I'm so interested in being in tech more recently, is because I think this new evolution is going to be quite fascinating.
How do people follow up? How do they learn more about ORIX and how do they connect? Yes.
Please reach out. My email address is my name, benjamin.wu@orix.com. And that's the best way to reach me. I would give my phone number, but there'd be so many people excited about this topic.
Fantastic. And for everybody listening, just so you know, of course, we'll have links in the website, all that other good stuff in the show notes. And speaking to the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. Each and every day, we're bringing you new content, new ideas, and of course, new content for your life. So hit that subscribe or follow button. And Benjamin, thanks for coming on the show.
Thanks for having me.